Mobile home parks are good investment. Well, I want to break down in the third quarter of 2025 how they're performing in this volatile real estate market where it seems to be lagging and a lot of asset classes are not performing. I'm going to break down some of the metrics based on Colliers' third quarter report so that we understand clearly that mobile home communities are continuing to maintain their value and trade at premium prices. That's why it's so darn hard to find a deal out there, because it seems like investors continue to invest in the story that affordable housing is here to stay. And even with high interest rates, cap rates are maintaining their values. So we are continually looking at where are rents going, where are cap rates going. So I'm going to break down this report for you so you get an idea and a snapshot of why mobile home communities continue to perform well, even in a down real estate market. All right, so Colliers just released their third quarter 2025 performance indicators for mobile home communities. Some of the key takeaways is mobile home community rental rates continue to show the healthy increases and occupancy remains high. So year over year, mobile home rents, and this is a reflection of our portfolio as well here at Patriot, is you can continue to raise rents at a favorable rate. Over the last 5 years, you can see rents on the low end went up 2.2% in 2020 with COVID, but then really aggressively continued to go up 7.5%. In 2022, like the rest of the real estate market, it was a 27% rent increase. In 23, it was 7%, and in 24, 6.8%. So year over year, we keep getting good rental growth, and that hasn't stopped. And occupancy hasn't been affected. Occupancy is still at that 93% range. And the reason being is that mobile home tenants own their home, the majority of them. And it's very expensive to move a mobile home. Could be over $15,000 to $20,000 with all the costs to transport it and install it somewhere else. So that's a lot of leverage where mobile home communities at times have raised rents really aggressively, and it's been creating some volatility where states are now possibly regulating rents, yet the majority of the market is still not on rent control, and rents continue to go up. The average rent in the Northeast is roughly $574 for a lot, and that is the land. So we're talking about land lease communities, not rentals of mobile homes. And then on the high end, on the West Coast, lot rents average close to $900 because of the expensive cost of housing on the West Coast. Cap rates have remained relatively steady, and this trend it hasn't shifted, really because of the stability of the industry and a lot of capital chasing mobile home communities, because as you own the land, you drive high margins. Here they're showing the average expense ratio on 44% on the high end. I don't think this is as accurate, and this is only for very nice communities. I think the average expense ratio is roughly between 40 and 50%, but there's still high margins compared to other asset classes. And the sector benefits because affordability still is in high demand. And even with the stock market down, these are the prices of the REITs, these are the four main mobile home community public REITs that are traded. And REITs right now are not trading well with interest rates and with the stock market being not loving real estate at the time. The market's not really valuing the assets as increasing in value because of the net cash flows being down because of interest rates. But overall, the industry stays strong and investors continue to buy parks at premium cap rates. So we're looking at cap rates here. What are the values of these assets? On the low end, you're seeing cap rates at 2.6%, 3.6%, 4%. There's crazy low cap rates, but the averages across the different regions of the country are right around that 5 to 6% range. And we've seen that on some exits that we have sold in mobile home communities, which makes it tough. It's hard to find a good, stabilized, quality mobile home park above a 6% cap rate. So the market's saying we like the story. We want mobile home parks because we know long-term they're stable assets that we can continue to drive revenues on and keep expenses reasonable. And you can see interest rates with life companies, CMBS, different regional banks. Interest rates are still high. They're within that 6 to 7.5% range. So negative leverage on these assets, which is wild. But that shows you that the investor markets truly like mobile home communities, and rents continue to increase. This is a positive sign, but it makes it that much harder to go out and find real estate transactions that make sense in the manufactured housing space. That's why you got to fight like hell to go out there and uncover opportunities that aren't on the market, because if you're buying at market cap rates, there is not a lot of yield out there, and it's a long road out there. There has to be a value add component. And that's why when we buy assets, we have to fill lots, raise rents, improve the community. But yet you're rewarded because the cap rates at the end of the day are very strong when you want to exit.